If you own stocks right now, that is the most important data you will see all week. Bank of America's Bull Bear indicator just hit 8.0. That is a formal sell signal. But that is only one piece of the puzzle. Right now, 5 separate institutional risk indicators are flashing extreme euphoria at the exact same time. Most retail investors will see all of this data and do one of the two things, either ignore it while we grind higher, or panic and short everything in sight. Both of those are wrong. I spent a decade on the institutional side as a hedge fund trader, and in this video I will show you exactly how the smart money is repositioning in this market and why my cash position is my strongest weapon right now. On top of that, the Iran agreement just changed the oil equation, and I will break down exactly what that means for inflation, yields, and your portfolio. The University of Michigan's Consumer Sentiment Index just hit 44.8, the lowest reading since the survey started in 1952. One-year inflation expectations surged to 8.3%, the highest in recent history. And yet, the S&P 500 is at all-time highs, 8 consecutive weeks of gains. This is the K-shaped economy made visible. The top 20 to 40% of households who own financial assets are driving GDP growth through the wealth effect. The bottom 60% are experiencing a different economy entirely. Stagnant real wages, rising costs, and zero participation in this rally. And here is the structural layer underneath that I have been tracking in multiple videos. The national debt just crossed $39 trillion. I repeat that, $39 trillion. And this is the chart that matters. Between 8 and 10 trillion in Treasury debt matures in 2026 and 2027. Most of it is a short-term bills issued during the pandemic at near zero rates. Every dollar of that must be rolled over at today's rates, north of 4%. Net interest on the federal debt has already surpassed 1 trillion annually. Now, before we get to the 5 risk indicators, there is one geopolitical shift that just changed the equation. This is the Iran deal. I promised I would cover this. The United States and Iran just reached an agreement. Uranium stays in Iran and the Strait of Hormuz remains open. Iran retains control over the strait, but in my view, this is essentially buying time for the midterms. Not a final deal, but in the short term, we will probably see oil flow more freely, which should ease some of the inflation pressure. However, the damage is mostly done. Fertilizer costs, transportation costs, producer prices, they already skyrocketed. And while crude oil might drop from here, I do not expect it to go straight to $60–70 range. There is too much short interest in the oil right now, both from traders who are short and from industries that desperately need it. So we would likely see buying on every dip. And this is the proof. The World Bank's Global Supply Chain Stress Index, based on actual shipping volumes, has risen back to nearly its pandemic peak. So even if oil eases from here, the supply chain damage is already baked into the costs. This is why inflation does not just disappear overnight. And here is what this could mean for your portfolio. Sectors that got crushed by higher oil, like airlines, logistics, anything with heavy fuel costs, those could see a rebound. And if oil easing feeds into lower inflation prints, that could take some pressure off Treasury yields, which also means we could see some bidding back into gold. But we need to wait for the next inflation prints to confirm that. But here is where the data tells a completely different story than the headlines, because the last 3 times consumer sentiment was this low, including June 2022, the S&P 500 was actually higher 12 months later. So the bears who are shorting because consumers are miserable, historically that has been the wrong trade, but that does not mean the underlying risks have gone away. It means Timing is impossible, and that is exactly why I'm not shorting right now. I'm simply managing my risk. We are getting to the part that surprised me most in the data. Now let me walk you through the 5 risk indicators that are simultaneously at extremes. I showed you some of these in the previous video, and with the latest data they have gotten even worse. Number 1 is the FINRA investor margin debt relative to GDP. So it is at 4.09%. That is an all-time high. It exceeds the peak of the dot-com bubble in 2007. In all 3 historical instances where this ratio exceeded 3.5%, while consumer sentiment was this low, the market experienced a correction of 25% or greater within 18 months. But, and this is critical, the market rallied an additional 7 to 10% first in each case. Number 2 is the Goldman Sachs Risk Appetite indicator, and it rose to 1.1, the 99th percentile since 1991. So Goldman strategists call it a double high because their momentum Z-score simultaneously surpassed 3.0. That combination has not been seen since early 2000. The next one is the daily total notional value of S&P 500 calls traded, and it hit $2.6 trillion. That is a record. Look at the shape of this chart. It is exponential. And if those 3 weren't enough for you, the next 2 are the ones that actually keep me up at night. Look at this. Hedge fund exposure to semiconductors has surged to 19% of total global net exposure, while software and services collapsed to 2%. That is very high concentration risk. And look at this, the AI Big 10 now represents 40% of the US stock market, matching the concentration levels of the Nifty 50, the Japanese bubble, and the TMT era. Every prior instance at this level eventually mean reverted. And there is one more signal that I think ties all of this together. Goldman Sachs data on annual US equity issuance. IPO and follow-on offerings are on pace to hit nearly $600 billion in 2026. That would be the highest level since the post-COVID liquidity surge in 2021. Why does this matter? Because in my experience, massive spikes in IPO issuance happen when insiders and companies sense that valuations are stretched and liquidity is abundant. They're cashing out. They're selling equity to the public at peak prices. And every major inflation point in the last 30 years was preceded by exactly this pattern. The dot-com peak, the 2021 mania, and now 2026. And this is where it gets structurally important because private credit defaults just hit a record 6%, the highest level since Fitch started tracking. And JP Morgan, one of the largest banks on the planet, is actively trying to offload $4 billion in private equity-linked loans. So this is institutional behavior. The largest players are quietly repositioning. However, there is no systemic transmission mechanism yet. Unlike 2008 mortgage-backed securities, these losses are contained within specific funds. The risk is real, but it is not contagious, at least not yet. Now, 2 more data points that directly affect your money whether you own these stocks or not. Walmart beat on revenue and EPS, but the stock fell 7%. When the largest retailer on the earth tells you the consumer is cutting purchases, that is a data point. Nvidia just reported their earnings. Revenue hit $81.6 billion, up 85%. Their Q2 guidance was $91 billion, handily beating consensus. They even announced an $80 billion buyback. The headlines screamed that they crushed it. but the stock still slipped nearly 2% over the following days. And this exposes exactly how retail investors get trapped. Retail sees the word beat on a news ticker and they blindly hit buy. But institutions are playing a different game. Here is what the smart money was actually looking at. First, the whisper number. The whisper number is the unofficial expectation that hedge funds and buy-side desks truly hold. While the official revenue consensus was $78.8 billion, the true buy-side whisper was already modeling over $80 billion. And for Q2 guidance, the whisper was closer to $90 billion. So a $91 billion guide did not trigger the explosive shockwaves we saw in 2023 and 2024. At $5.2 trillion valuation, it was already completely priced in. Second, the shift from hypergrowth to cash cow. Retail investors cheered the $80 billion buyback and the dividend increase, but on the institutional side, many view this as a subtle signal from the management that the runaway for exponential growth is slowing. Nvidia is transitioning from a pure disruptor into a mature blue chip. And finally, it is the shift toward agentic AI. While Nvidia GPUs dominate the training phase for large language models, the next phase of AI, this is the autonomous inference, will see CPUs playing a more critical role. Institutions are already evaluating the risk that competitors will capture more of this upcoming hardware cycle. This is why Zacks Investment Research downgraded Nvidia from a strong buy to a hold right after the print. And that triggered a wave of institutional profit-taking as portfolio managers rebalance their positions. Nvidia's business is stronger than ever, but the stock drop was not about poor performance. It was a realization that the stock is priced for perfection, and merely destroying the official consensus is no longer enough to send a 5.2 trillion titan higher. Institutions were parsing the valuation, the slowing growth runaway, and the China risk. Meanwhile, retail was just buying the headline. What do you think about the global macro dynamics right now? Please share your opinion in the comments. I read every single one of them. And this is where it all comes together. A melt up, a pause, or a correction. Where do we go from here? Now, the bull case for a continued rally. Earnings are still holding up and AI capital expenditure is accelerating. Goldman's momentum factor has surged 25% over 3 months, and historically rallies of this magnitude often result in a pause, not an immediate stop. However, that bull case rests entirely on earnings growth continuing to materialize at current valuations. The forward price-to-earning ratio is 21x. If AI capex returns disappoint or revenue growth ex AI decelerates, this entire framework collapses because the market is priced for perfection right now. And Nvidia's earnings just prove perfection is not always enough to keep stocks going up. And here is the part that should make you pay attention. This is the size of credit default swaps positions on the hyperscalers. The very companies that are supposed to be driving this bull market. CDS positions are surging. For those unfamiliar, a credit default swap is essentially insurance against a company's debt defaulting. When the size of these positions explodes, it means institutional money is quietly buying protection against the possibility that these companies could run into serious trouble. While retail is buying the AI narrative with both hands, the credit market is telling a very different story. Here is the bear case for the correction. Private credit defaults are at record, margin debt relative to GDP is an all-time high, financial conditions are beginning to tighten. The global financial tightness indicator pushed forward 9 months is signaling ISM manufacturing weakness ahead. The Fed is holding rates at 3.5 to 3.75% with no cuts expected until 2027. And the new Fed chairman, Kevin Warsh, is an inflation hawk. His first FOMC meeting is June 16th. Historically, stocks under new Fed chairs experience an average max correction of 15.2% in the first 6 months. But 1 year of those woes, the average return is plus 18.5%, with 87.5% of instances being positive. The weight of evidence suggests volatility ahead, and volatility is an opportunity if you have dry powder. The data prints that will confirm which scenario plays out are the June FOMC, the dot plot, the next CPI print, and whether private credit defaults breach 7%. So here is what I'm actually doing. As an investor, I want to deploy capital, but right now, based on everything we just walked through, the risk-reward is completely asymmetric, in the wrong direction. There is a major misconception in investing. Retail thinks that being bearish means you have to aggressively short the market, that you have to borrow shares and bet against the trend. That is the fast way to lose your entire account. Institutions know that being bearish just means controlling exposure, raising cash, and protecting capital. Here is exactly how I do that. First, cash is a position and it is a weapon. Holding a higher than average cash position, for me up to 30% right now, is not missing out. It is my defensive asset class. And here is what I promised I would explain earlier. I do not actually hold cash sitting in a bank destroyed by inflation. I hold short-term money market funds yielding around 3.5%. Most major brokers now let you park your uninvested cash in these short-dated instruments to earn yield while you wait. It gives me the opportunity to buy the pullback, and it pays me to be very patient. Second, trimming into strength. When the market is euphoric and we see these unnatural upward pushes, that is the exact moment institutions quietly sell off portions of their positions. They walk in gains and raise cash, while retail is panic buying the top. Third, participating while protected. You do not have to go to 100% cash. You maintain your long exposure so you can still catch the upside if the market continues to rally, but you reduce your size. That way, if a sudden correction hits, you do not get wiped out. And fourth, portfolio insurance. So think of put options like buying the insurance on your house while you still live in it. You hope your house never burns down, you hope those options expire worthless, but the premium you pay is a fraction of the cost of having to rebuild your entire portfolio after a crash or a correction. And finally, waiting for asymmetric setups. The number one goal of every investor is to stay in the game long enough to see what happens. So I'm not trying to time the exact stop, I'm simply waiting for the broader macro picture to clear and for the risk-reward ratio to become highly asymmetric in my favor, before deploying that capital again. Most people I know have only been trading for at least 5 years. That is the shortest possible sample size. When people forget about risk and think stocks only go up, that is precisely when you need to be very careful. So melt up or a correction, the data prints will tell us soon enough either way. And that is why risk management and portfolio management is the most critical aspect of investing. See you in the next one.